Smart money believes Adobe's empire is finally crumbling, and as it seems, the stock price confirms this. But is this a realistic picture? Adobe is currently undoubtedly the juggernaut in its space, but would that remain in the future? Let's together find out the reasons behind this decline and if the company is a buy at current levels. Starting with declining growth. The data shows revenue growth has slowed down from around 20% from 2016 to 21 to just above 10% in the last 4 years. For a high-flying tech stock, this slowing down is often the first sign of maturing market. This results in a retracting multiples and lower valuations. So this is a point to all the bears, as who says this will stabilize at around 10% going forward. Looking at the flip side, Adobe is currently trading at roughly 10 times forward earnings, while in recent history it was trading at a mean of 38. So for the bulls, if the AI fears are even slightly overblown, the re-rating potential is massive, and this can be then turned into a massive melt up. Moving on, I would like to focus on EBITDA and cash flow from operations. Here on our graph, what we can observe is that cash flow from operation in red is always above EBITDA, and both are moving in the same direction, which is exactly what we want to see. As cash flow from operation is always higher than EBITDA, this means Adobe is collecting money faster than it is recognizing its expenses. And the company's net income is backed by the actual cash entering the bank account. But here we need to point out stock-based compensation, which accounts for nearly 20% of the cash flow from operation. But as Adobe is massively reducing the shares outstanding, this is not a problem in my eyes, as the shareholders are not diluted. The next thing I would like to point out is CapEx. For a company of this size and in this sector, the CapEx is extremely low. For the last 2 years, it was less than 1% of revenue. And the CapEx is so low because they don't have servers, as they got space for their cloud services from other providers like Amazon. They also don't put as much effort into AI like buying chips, but they rather partner with the likes of Google and Amazon to use their AI capabilities. Now this in my mind is or left behind story or the smartest decision in this sector, as new tools from companies like Anthropic, OpenAI and even Alphabet's NanoBanana are moving beyond generating images to automating workflow. If any AI can build a website, do a video edit or edit a picture from a prompt, the need for a human to spend 10 hours in Adobe Premiere or any other Adobe product vanishes. At least this is the narrative. And as Adobe is not putting as much money into its own AI capabilities, in case AI becomes even more powerful tool in the future, which will definitely become, it's maybe just a matter of time when Adobe will be left behind. On the other hand, bulls can argue deep enterprise integration. Adobe isn't just an app, it's a workflow. Moving a massive creative team from Photoshop or Illustrator to a new tool or even prompts involve massive switching costs. And this takes into account retraining and also file compatibility. So the companies won't just leave Adobe overnight. But here I would like to point out something else as well. Most of their expenses come out from developing software, which falls under research and development and not into CapEx. And here Adobe invests just shy of 20% of revenue. And now lastly in this section, let's look at free cash flow, which is very closely trading to cash flow from operations, as the CapEx from which is calculated is very low. And again, here you need to be very careful with stock-based compensation, as again is taking more than 20% of free cash flow. So now let's move on to see how much residual cash Adobe generates. This is very important metric because higher residual cash means the business earns a lot from its primary business. To calculate it, we'll need net income, depreciation and amortization and deferred income taxes. We sum everything together and we subtract out capex from the sum above. Adobe doesn't pay any common and preferred dividends, that is why this section here is empty. And now we come up to residual cash flow, which is very high and is the same as free cash flow in this case. And now if we translate this into per stock basis, we come up for both metrics that the company's core business should be worth $260, which is basically just a little bit less than what Adobe is currently trading for. But of course, this is taking into account the past. Adobe will grow in the future, so let's look at how much the Adobe is worth 3 years from now. But before moving there, I can also mention that here the free cash flow is lower for approximately just the size of stock-based compensation. Okay, so for future projections, I was very conservative, as I cannot exactly tell if AI is a threat for Adobe because I'm using Adobe and their AI is actually not as good, but it is improving quite a lot, so you can help me with that in the comments below. But nevertheless, I put the revenue growth at our bear case for 4%, for our average case at 6%, and our highest assumption or bull case for 8%. And I know this is very conservative. But let's see what kind of stock price we get. Net income on the other hand reaches from 25 to 29%, with 25 being the long-term average, and the same applies to EBITDA, which 35% is a long-term average. Cash flow from operation is calculated from EBITDA, and as we know, cash from operation is higher, so I put its correlation at 110%. What can I also mention is that here in orange we have analysts' numbers, and everything that is red in our table, like in this case over here, it means that we are expecting higher numbers than analysts. Now moving on, I put in the higher capex just to be conservative if Adobe maybe switches the play on AI or any cloud services. And from this we can calculate our free cash flow, which across the front with 2 exceptions is lower than analysts' numbers. Now before we can calculate the stock price from these numbers over here, we need to discount them back to today. And a discount factor for Adobe is set just over 12%. And because above I mentioned the stock-based compensation is around 20% of free cash flow, I accounted this in here as well, just again to be conservative. And now finally we can calculate our first perpetual growth rate. So our stock price here, which accounts also for debt and cash, is ranging from $223 to all the way to $280, with our average being just shy of 270, with analyst numbers being below just 300. Now before we do any conclusions, let's calculate our second valuation, which is EBITDA multiple. Here we take 2 EBITDA multiples. One is for company average, which is currently sitting at around 33, and one is for the industry average, which is currently sitting at around 22. Let's keep in mind that the company average here is very high. We mentioned that average forward earnings from the last few years are sitting at 38 and currently is sitting at around 10. So that means that if the company is slowing down, this company's multiple will contract, and we need to take this into account. But nevertheless, to calculate this, we simply take 2028 EBITDA multiples and we multiply it with the given multiple. And again, if we account for debt and cash, we get our stock price range from $570 all the way to $700 for the company average, and for the industry average, we get a stock price range from $380 all the way to $475, with analysts coming in at $865 and $580. And now for our final stock price, we average perpetual growth rate and EBITDA multiple. And for company average, we get the range for 316 all the way to 400. And for industry average, we get 240 all the way to $300. And here we have margin of safety of 20% applied to these numbers over here. And also for our average number, and also for analysts' numbers. Now these stock prices over here, I would say, are for the Adobe, where AI is not a threat. But if AI becomes a threat and the lower growth continues, then the company might be trading closer to 11 times its EBITDA. So if we put 11 just as an example, then the price range changes dramatically. And for the company average, then we get a range from 160 to 200. So now what should you pay for the stock? For this, I have 2 different scenarios. For the first one, let's look if AI is a threat and a declining revenue occurs. Here we have 3 buying prices based on how much of a hit Adobe will take. If you believe Adobe will basically begin to stagnate, then you shouldn't pay anything more than $250 in this case. If Adobe's growth in revenue falls in half, so it will be roughly around 4 and 5%, then you shouldn't pay anything more than $230. And if the revenue falls just slightly, let's say around 8%, then you shouldn't pay anything more than $250. Now, on the other hand, if AI is an opportunity, but the revenue doesn't pick up again, then what we get is only the multiple expansion. Then you shouldn't pay anything more than $219 on the lowest assumption and $330 on our highest assumptions. For me personally, I believe $260 is a right price for Adobe, as I believe AI threat is a little bit overblown, but still it is not exactly the opportunity either. That's why I believe $260 is the right price to pay. With this in mind, if Adobe stays at current levels, I will start a small position in it. So please do let me know in the comments below what do you think about this analysis, what is your buying price, and what do you believe Adobe will be trading in the near future. And if you really enjoyed the video, please do subscribe and hit the like button, as it takes quite a lot of effort to do this analysis. And I hope I'll see you in the next video. Bye bye!